There it is. Okay. All right. So officially, it is July 30, one day before crucial month-end options expirations. I'm sure we'll get to that. I'm Tim Quast with Market Structure Edge, and along with me, back from the jungle of Guatemala, is Brian Wilson, market strategist. He is, since you've heard from me the last two times running, I'm handing off to Brian. I can have some remarks at the end. I've got things to cover, but Brian's got more. So, Brian, thank you. Over to you.
Yeah, thanks, Tim. I appreciate it. Great to see everyone again. I do miss you guys when I'm gone. I think Tim and I have mentioned, many times, interaction is welcome, whether it's here on the live discussions, or whether it's through email. All your questions are welcome. So we appreciate you guys. I did want to start today by looking at something that perhaps we don't talk about too often, and it's actually just the lead behaviors. So let me show you what I'm talking about. So if we're looking at a portfolio, so for instance, my all equity portfolio, what's the lead behavior right now? Well, it's fast trading. You look at the Dow Jones, it's fast trading. You look at some of these other ones, a lot of them are fast trading right now. A few are passive investment. You can see fast trading actually for the Magnificent Seven. And I wanted to talk into specifically these two behaviors, fast trading and passive, for a moment. It's just a way to think about things. Let me bring up a stock so you can see an example. So let's say that you're watching Lamb Research on a regular basis, and you look at it every day. Let me get to it a different way. I want to show you the behaviors. I think it's under my semis here. So let's say you're watching a particular portfolio every day, and you notice one day that Lamb Research changes. Here's the lead behavior when you're inside a portfolio, and it changes to passive money. How can you think about that? Well, we're going to talk in general terms for a moment. Passive money, a lot of times they will be there at the start of a rally. So let's say that Lamb Research, instead of demand being 1 right now, let's say that sentiment or demand is at 7 or 8. It's moving higher, and passive money has just come into the picture. There's a pretty good chance that you're going to get some appreciation over the next few days. So in other words, you're starting to get passive flows coming in. Recognize that when you start to get what we call these trading patterns, they tend to last, and each stock is a little different, but they tend to last for about 5 to 7 days at a time. So let's look at Lamb for a second. Obviously not a buying pattern. Lamb's been under a lot of pressure. What is it right now? It's fully washed out. I didn't go back and back in time here, but I would guess that it's probably been under passive pressure for the last week or two. So a couple different ways to think about it. One, if you're kind of at a start of a rally and you're starting to get some passive investment buying, that rally is likely to continue. If you start to come under pressure and you're seeing passive investment, well, that pressure is likely to continue. So just a couple different ways to think about it. Now, let's say that it's just the opposite, and we've got CLAC here as an example. CLAC currently has fast trading as their lead behavior. So somewhat similar to what is happening with LRCX, coming under pressure. You can see that sentiment is fully washed out. Recognize what fast traders are going to do. A lot of times they're going to amplify movement. So if you see them in a stock that is in rally mode, a lot of times you'll see like a passive investment, we'll call it pattern. You'll see passive investment influence, then you'll see fast traders tag along, and the stock will just go vertical. So just because the machines are there as the lead behavior doesn't mean that the stock can't continue to go higher. In fact, a lot of times you can get a little bit of a momentum rally, and the stock can truly continue to move higher for quite a while. The opposite can occur on the way down. They're going to amplify some of that downside movement. You can see it happening right here with recent activity. So two different behaviors, two different ways to think about things. A lot of times you'll see that passive influence at the start of a rally. You'll see fast traders amplifying it, and then you'll see just the reverse when things start to turn the other direction. So I just wanted to mention that for a moment. Somewhat similar concept when you see passive investment selling. Sometimes it can be, and I mentioned it in the note this morning, and I'll show you a slide here. Sometimes it can be ETFs that are washing out capital gains. This is one slide that we use for some of our modern IR clients. It talks about in-kind redemptions. And essentially the concept is that the Vanguards and the BlackRocks of the world are trying to get rid of tax consequences. So as an example, they're removing stocks that have greatly increased in value. So let's say that you have a security that has been on a complete tear. Well, at some point, they're going to come under some ETF pressure. And you might hear some news item, some random news item that, this is the reason that it's coming under pressure. Well, maybe, but more than likely behind the scenes, you're just quite simply getting those stocks that are going into the redemption baskets for a period of time. Once those capital gains get washed out, guess what? They're ready to move higher again. So you get these cycles that play out over time. Sometimes if you get unexplained moves in stocks, and if you see passive investment as the lead behavior, that can sometimes point to some of this ETF activity. For a moment, I want to, let's go to a couple of software names here for a moment. We've seen a little bit of a rally in some of the software names leading up to today. And you can do something similar if you're so inclined. You can create a portfolio if you know the peers for a given name. So this is Zscaler. They have 11 different peers, 12 including themselves. And you can look at the collective sentiment. Now, if we look at Zscaler, they've been having a pretty good rally here leading up to today's trading. Share price has been moving from 140 all the way up to 153. Not bad, especially with the year that we've had so far in the software space. But if you look at this type of activity, and you're like, I wonder if I should buy Zscaler or some of their peers. What would this chart tell you? Well, it would tell you to probably avoid it right now. Even though there's been a little bit of a rally in the space, that rally is not showing up yet in demand, not even bottoming to this point, certainly not moving higher. What this tells me is that there's some instability still in the space. If there wasn't, sentiment for the collective space would be 8 out of 10, instead of being 2.4. What can happen in this type of environment? Well, you can have additional volatility because sentiment hasn't stabilized. And indeed, that's what we're seeing today. So just a way to think about things, because sometimes we get these, huge moves in the market and we're like, where did that come from? Could that have been predicted at all? And when I was thinking about it this morning and looking at Zscaler as an example, yes, if sentiment is weak, that's telling me that for now, I don't want to be in the space. So just something to think about. And once again, you can form these portfolios. This is the list of Zscaler's peers, and then collectively you can get a pretty good idea of what's happening in the space right now. The only one of the peers that's above 5 is Sale. That's very telling, just with that right there. Wanted to go back to big tech. You hear me talk about big tech almost every single time that we have this discussion because it's important. You look at the big tech sentiment right now, it's all the way down to 2.7. It's just been sliding lower over time. A lot of the big tech components have been just under a lot of pressure. We're aware of that. It's been occurring over time. And in fact, I was doing a little bit of research. This was kind of interesting. I'll show you this site. Chartrow.com list/Magnificent Seven. It goes over time. You can see performance on a 1 week basis. This is through right now, actually about 20 minutes ago. So last week, Microsoft up, most of that occurring today, obviously. But if we look at the overall performance, and this will list the Magnificent Seven going back to 2017. If you wanted to look at NVIDIA, you can see the returns over time, and obviously they've been stellar. But if you look at this year, what's everyone doing so far in 2026? Not much. The only one that's doing anything is Apple, with returns of about 22%. And Apple's been pretty good over time, if you look at those performance numbers. But also, one thing that this communicates is you can see here in the gray bars, the total returns for the S&P 500. And I don't think it shows the numbers, but you can see that when we have less influence from the Magnificent Seven, that overall return for the S&P 500 declines. And it's certainly the case so far this year. Apple being the best performer, once again, 22%. We've got Google coming in at 7%. Amazon before earnings this afternoon, a little over 3%, and NVIDIA about 4%. And SPY is coming in at 8.6 right now. So just fascinating. You can compare that over time, but it gives you an idea. What's happening. You look at Tesla, down 32%. So tough year for Tesla so far. But big tech, it's weak right now. And I went back to the latter part of March. And this is just a spreadsheet that I keep. You can see it right here. It's big tech. And I track sentiment every day for big tech and some of the other portfolios. And then I'll track the short volume as well. But if you look at big tech back in March, it was weak. The broad market had gone below low fours, 4.3, 4.2. Big tech was down below 3. And if we look at what happened back at the end of March, it became an inflection point for the broad market. So market was very weak coming into that time frame. A lot of pressure. This is SPY here in blue. Market structure sentiment is in green, but you can see the weakness. And part of that weakness was because big tech had been weak. And we come into the end of the month. What happened at the end of the month? Well, big tech was better to buy. So we caught a rally right there the last day of the month, 31st. Big tech continued to rally. The whole market went into rally mode. But recognize that at that point in time, big tech had been pretty oversold at 2.9. Magnificent Seven was down to 2.3. If we look at the setup right now, we have big tech at 2.7 and the Magnificent Seven 2.6. It's a pretty similar setup. I don't know if we'll get similar results or not, but you can see that we're oversold right now. And it's part of what I wrote about with this morning's note. 2 weeks ago, tech was the lead sector behavior. This last week, it's been the worst behavior. And I think part of that has been a little bit of ETF, washing out some capital gains. So we are at an inflection point. And part of what I'm looking at here at this inflection point, we are coming up with a couple of key earnings after the bell. And if we look at it from a big tech perspective, if if we get big tech that continues to roll over, it's currently 2.7 as of the 28th. If it continues to roll over, I think it drags the whole market lower. The broad market right now is okay. It's 5.3. That's fine. A lot of times the most significant weakness we'll see is if the market breaks below 5, that period between 5 and 4. So we're obviously not there right now. We're above neutral. Everything's fine. But if big tech does continue to roll over, if we don't get any assistance from Apple and Amazon after the bell, maybe sentiment rolls below 5. I don't think that will happen, but that is certainly kind of a scenario to think about. With that, I'll stop sharing and see if there's any questions to address.
Anyone? Anyone? To use the Ben Stein line
Right.
from Ferris Bueller's Day Off. I didn't do it in his voice, however. Okay, well, but again, interrupt us at any point. Thank you, Brian. And I should have mentioned, Brent Slava is here too from Stock Trader Network, stocktradernetwork.com. So Brent, thank you for being here. I love spending time with those guys. Dennis Dick and Joel Elconin is always a great, fun discussion. Let's see. Okay, then I've got a few things to begin. Just interrupt us, but I'm going to share my screen here and cover a couple of things. Right at the top of my list is what about this? The core to what we do is demand supply volatility. And this volatility today, it is astronomical. There's absolutely no reason for any number that a company reports of the size of Microsoft that the price should move 16% in a day. I think SanDisk was up 26%. I looked at all these things. In fact, it was really interesting to go look at the daily trading ideas. If you look at how those performed, they all shot past the entry point. And then what do you do with that? If you look at I can't even remember what NBIS is, but you can go look at what happened. How would you, if you looked at that and how the price has been beaten up, how would you know that might smoke today? Well, look at the divergence. Strong demand, falling supply. I'll get to the larger point, but to move so dramatically like these things are moving, it is if a stock shoots through the entry point, I'm not going to chase that. The probability that you have missed the all statistically significant returns is high, and it comes back to why this is occurring right now as opposed to some other time. Certainly, it's the heart of earnings season, and earnings can be very distorting because we've talked about this before. We have a pretty good read on demand and supply, but there are enormous bets that are made, particularly by large hedge funds. I've mentioned before that the data show that in 2026, hedge funds have average leverage around events of 24 times, meaning that if you place a $100 million bet on it, when you put everything together from the borrowed money to the derivatives, that you have it's worth 2.4 billion in terms of its economic impact. In fact, have you seen the news about this outfit called Situational Awareness? Extraordinarily successful hedge fund that went from 200 million in assets to 10 billion in just a very short stretch of time. But they basically failed. They're not closing, but they had to sell their entire portfolio to Citadel because of the dramatic volatility in the chip group, in the AI trade. It caused them to fail. It's what happens when you have leverage and the leverage moves against you. And that's what you're seeing playing out. Well, the market has seen a tremendous surge in leveraged instruments and ETFs, exchange traded funds and products. And when you have a 2 or 3 times lever and there is dramatic volatility, somebody constitutes that of what backs that thing. So the fund says we're going to replicate a 2 or 3 times the performance of some. So, well, what happens if it's SanDisk? I mean, and you have a 3 times lever on that. It's nice for whoever holds it, but the party that is backing that has to make good on it. Well, what if you it could be catastrophic. It could cause somebody to fail, could cause a bank to fail. If a bank committed to supplying that return, it's enormous. What is the math on 16% of Microsoft's market cap? It could be all of the capital that somebody has who took the other side of that trade. And it happened. I always say when these things happen, they are indicators, they're signals, they're warnings. You don't just go, well, what happened there? It's a consequence of what's occurring here. And these moves are abnormal because maybe, I don't know, we reached a tipping point in the amount of leverage that is in the markets? I don't know. The only defense that one has in this kind of condition is to recognize that if things move more than the entry range, and this was a big entry range, this stock has a 13% trailing 5-day volatility in it. It moves. Well, it moved a lot more than that today. And so when that is occurring, that leverage is involved and that there is the winner and then there's a loser, the party who supplied the return. And those things are going to get recalibrated every day. Well, what might happen tomorrow? I don't know what's going to happen tomorrow. I very much believe that what is happening today in our market is a consequence of what happened the last 2 days in South Korea, where you have these touchstones, SK Hynix and Samsung, and that market lost 1/3 of its value. It's up a lot. But what might someone do? Well, if you have leverage and horsepower, you would say, could we move them the opposite way in some other market? That's an arbitrage trade. And again, how do we defend ourselves against that and know, well, how do we know, okay, is the market now turning and do I need to jump back in before I miss all the gains? What do I do? And we always come back to broad sentiment, context, and divergences. There are, 16 in this momentum portfolio. But that's still not, these are not what I would call ideal volatility trading conditions because there really aren't a lot. If we have 30 of them, that's a pretty good indication that we have opportunity and it will not move in a way that would cause us to suffer sharp losses. That's what you don't want to have happen. Broad sentiment, where is it? I wrote maybe even twice in the notes that historically the market has never surged from its current level at 5.3. That's positive. It's above 5.0. And so that's our defense is demand and supply trump price. We say don't trade price. Price is capricious. It can move for all kinds of reasons that may not be sustainable. And so you look at this and say, well, supply is coming down off of a peak. Generally, when that happens, it could mean that whatever condition is playing out might be ending. But if indeed the market does not move sharply and dramatically from these levels, we know there's likely to be a reversal of that. I do not know. Who knows what's going to happen? The market is given to these extraordinary moves, again, because of all the leverage options, all of those, the delta gamma, hedging, scalping, the jargon terms, and I can put it in very simple English. If you have a short-term position in stocks and related options and the prices of them both move, they will prompt reactive behaviors. You may have to do certain things. And much of that is programmed and it can run away. Then there will be winners who will be like, well, I made a lot of money, and then there are going to be losers and consequences. And what happens when people lose? They have to sell assets. And so then just when you think everything's going your way, it kicks the legs out from under you. So I always come back to these numbers. And these numbers tell me that historically, the central tendency is that we are not going to have a dramatic move, which means that if we're experiencing a dramatic move, it's very likely to reverse. Again, I don't know. But this is the kind of very dangerous condition where you do not know what's going to happen. But I'm always settled by being able to look at the dashboard and look at the demand supply balances. This is the awesome trading demand supply balance. And we have choices, but not a lot of them. Out of 2,000, as Brian pointed out, why isn't there 3,000 stocks in the database? Because the chunk of them are less than $1. We run the data on everything that is in these data sets come from core sources that will have all of the data, and we put on the platform everything that has actual underpinning data. And we're down to like 2,800 to approximate the Russell 3000 at present. But I look at the demand supply balance. There's the demand supply balance in this small AI portfolio. It's a small one. I mean, is that likely to reverse? That's a very long run. Yes, it's likely to reverse, but it's not great. I mean, I certainly don't know if that has turned. I'd say you wouldn't like jump in front of the freight train and say, well, I'm just going to guess that has bottomed here because they're jumping today. I don't know. I said to Dennis and Joel the last time I was on, I would look at airlines and cruise ships because they're down here, but I was wrong, right? They have not recovered. I would look at that and say supply is high, demand is weak, not something you would buy. You can look across the entire market here. As Brian pointed out, big tech looks just like AI, yet Microsoft up 16% today. Options expire tomorrow. The trillions of dollars are benchmarks to these resets, and they're trying to track a benchmark. And when you have dramatic volatile moves, when you're trying to get yourself aligned with the benchmark, there will be consequences. When stocks move dramatically like this, there are portfolios that are supposed to not have volatility that now have imputed standard deviation. That will be a problem. I don't know what the consequence will be, but one has to be aware of all of these factors in the market. Most people don't think about them. You just look at charts. Well, no, there's plumbing and mechanics and rules and measurable behaviors and a cadence and calendar, and all of that has to be factored into the equation. Looking at the Dow Jones, I mean, it looks good. Just remember that the Dow Jones 30 stocks are all also in the S&P 500. How could they behave differently? Well, this one is price weighted. The S&P 500 is market cap weighted. Well, I could come up with an arbitrage scheme out of that. Chase the high price stocks and buy calls on them over here and reverse the trade and lever into it. There are all kinds of things like that are going on. So we have to be wise and looking at the data and understanding the big picture. We can see what's occurring. We can see the demand supply balances. Gold is showing a nice little recovery. Financials, big financials, not great. I mean, they're bottoming, but I don't, that's not a great trade. There's pretty good divergence in healthcare. I mean, there's a spot if you were looking for safety, probably you would look at. You look at tech. Well, it again is one day is not a trend. I don't know what tech's going to do. There is divergence here in the sense that supply is falling and demand has flattened out, but it's below 5. Is it an entry point? Maybe it is, but it's not clear enough to me, and I'm certainly not going to do it right into options expirations. That's the important thesis. And you can do this all the way through your dashboard, and you can get a pretty good idea of where things are. I'll finish here because we're just about out of time. What I always come back to is there are very clear turning points. When demand picks up and supply is still divergent or falling, that's a great divergence. You look at the broad market, very rarely do we get good entry points below 4. We had one here. That was a great entry point. All this time, I don't think this is awesome. When demand is it doesn't have any legs, there are big fluctuations on the supply side, and it moves a lot more because supply is very elastic. And market makers can, short and cover and short and cover and short and cover and en masse. And so it is a very responsive aileron in how those things trade. I mean, this is positive, but I look at this market and say, I need to wait to see a few days. And in 2023, 2024, and 2025, the market was very rocky at the July-August transition. I don't know that it's going to happen again. But my conclusion that's my concluding comment. Do not be fooled by these wild moves in these stocks right now, because that is not normal behavior. It is a result of leverage, and there is consequence that will come from that. So that's my concluding comment. Brian, what about you? Anybody have questions, comments, observations?
Tim, Anesh had a question about the model portfolio. Which ones are active right now, and which ones are we following?
Yeah, great question. So right now we have 4 model portfolios in that in the for the folks who are using our model portfolios in the focus set of funds. The best performing, the only one that I would use right now is Focus 5s. It has very low turnover, and it has good returns. Just since June 1, it's up about 12%. So, and why is that working? It's a very simple reason. But again, it comes back to understanding how the market works and what the money is doing. If you are a large passive fund, an index or an ETF tracking the S&P 500, and there is volatility, you will necessarily have to buy more weighting in less volatile stocks. Otherwise, your standard deviation is going to cause tracking errors. You get in trouble with the regulators. Wholesalers will stop selling your fund to Schwab and everybody else. Very important to those people. And so if NVIDIA moves 6-8% and it's a huge weighting, what am I going to buy? Consumer staples, whatever. I'm going to find things that have less volatility, so that as my weightings in those things increase, it brings my standard deviation down. These are huge problems right now for these funds right into the end of July and the transition to August. But we also are running the contrarian fund. I don't think it worked well during March. I wouldn't recommend it. We stick with calibrating and calculating daily the core passive fund, because passive money is the engine of the markets, and that's not working. I noticed that Eric Balchunas from Bloomberg, he's very active on X, and he's a smart guy. He knows a lot about ETFs. He observed that $82 billion came out of equities the last month. It's going into money market funds and fixed income. Even though you see that interest rates rise, and interest rates can only rise if there is less demand for bonds. They move inversely. The only way rates rise on the 10-year is because people aren't buying the 10-year. They're buying the 2-year. They're buying very short instruments. That's what I did too. So what is the lesson out of that? And Ash, I haven't fully answered your question. It's that what is sustaining the market right now is a volatility trade, not flows. That's kind of frightening to me. And it's another reason why I'm going to carefully step around this. So Nash, there are a couple more in there, but really Focus Passive, we're data, not advice. We don't give advice. We say we're waiting for these conditions to improve. If passive money is back in the markets, we're going to see it in that portfolio. And it hasn't been there since May 15. I believe that that generally people are not contributing more money somewhere in the equation to their retirement accounts, and that some people are moving money out of the markets. And you say, well, why wouldn't the market decline? It got volatile, like really volatile. The NASDAQ corrected yesterday, down 10% from peaks. It is manifesting all of the signs. But it's very easy to get caught up in the moment and think, oh, the market's up 1.5%. Everything must be awesome. No, those are consequences of movement. So, Anesh, that's what we're doing. We're calculating them. We're constantly looking at what's the best horse to ride at a given moment. I think it's Focus 5s right now. Okay, we're a little bit over. Brent, Slava, Stock Trader Network, you guys can feed us questions too. Thank you for joining us. Brian, thank you. Good to have you back. Thanks for joining.
Tim.
Yes, Barry, fire away.
SpaceX, what's it look like right now?
I've ironically, that showed up in the Focus Contrarian model, which looks basically for junk. It says, well, that thing's at 1 and has really high short volume. What if it reverses? But we can take a quick look at it, and we'll make that the last thing.
What it's looking for future here.
Yeah, and it's a great illustration of the IPO market doesn't work. And even size is not enough. And why doesn't it work? Because the market is no longer designed to form capital. It is designed to let people exit and trade. Well, that's not great for IPOs. It will lead to poor performance. I mean, it's just terrible, Barry. It's like,
wow.
Like there's no demand and very high supply. It's just ridiculous. ridiculous, right? So you would not want to touch this until this number to me is below 50%. I mean, I'd even like to see it lower than that. But yeah, it is abysmal. You don't want to be in it, even though the model picked it up.
You think there's going to be a run down the line where people have to cover their shorts on this? And I mean, that's what
realize that's
threatening, right? He's threatening that all the people that have long or short positions, that basically they're going to get burned in the end. But it doesn't look like it to me. So
yeah, and it's, there's only a small percentage of that short volume that is actual what you could call short positions, where a person who believes that SpaceX is going to decline uses a broker dealer who must verify that they could locate shares to borrow. They have T+3 to do that. Right? You have to, otherwise you're naked short, and that's against the law. So that is a very small part of it, where you borrow shares and you sell it on a belief that the price is going to go down. A lot of this is market making, and they can cover their short exposure in a matter of seconds. And so you have to be aware. That's how people get caught out, right? It's very, very challenging. You cannot out short or out long Citadel, right? They're too vast and powerful.
Gotcha. Thanks.
Yep. Good to see you, Barry. All right, everybody.
You too.
Apologies. We went a little bit long. We'll see you next week.
Take care, guys.
You guys too. Thank you.
See you, Barry.